Ever wondered how the stock market works? Well, you're not alone. It's a bustling, vibrant ecosystem where buyers and sellers converge to trade stocks or shares of ownership in a company. Picture a marketplace, but instead of fruits, vegetables, or other tangible items, we're dealing with shares of companies. Now, you might wonder why the stock market is so important. Here's the thing, it's a critical component of a country's economy. It's where businesses raise capital to grow, innovate, and create jobs. At the same time, it's a place where investors, individuals like you and me, or big institutions, can invest their money in these companies, hoping for a return on investment as the company grows. It's like a giant, ever-evolving dance, with companies and investors moving in sync, each influencing the other. So, in essence, the stock market is like a giant global marketplace for companies and investors. Now, what exactly do we mean when we say stocks? Well, let's break it down. Imagine a company is a pie. When you buy a stock, you're essentially purchasing a slice of that pie. The size of the slice depends on how many shares or stocks you buy. Let's say a company has 100 slices or 100 shares. If you buy one share, you own 1% of the company. If you buy 50 shares, you own half of the company. It's as simple as that. But what does it mean to own a part of a company? Well, you have a say in the company's decisions, albeit a small one. As a shareholder, you can vote on certain company matters. The more shares you own, the bigger your voice. But the main reason people buy stocks is to make money. There are two main ways this happens. First, if the company does well and its value increases, the value of your slice of the pie, your stock, also increases. If you sell your stock for more than you bought it for, you make a profit. This is called capital gains. Second, companies sometimes share a portion of their profits with their shareholders. This is called a dividend. Not all companies do this, especially younger ones. They might prefer to reinvest the profits back into the business to help it grow, but many established companies pay dividends as a way of rewarding their shareholders. Now, it's important to remember that buying stocks also means you're taking on risk. If the company doesn't do well, the value of your stock may go down. You could even lose your entire investment if the company goes bankrupt. But don't let that scare you off. Investing in stocks can be a great way to grow your wealth over the long term. Just remember to do your research and understand what you're buying. So buying stocks is like buying a piece of a company's future and its profits. How does the buying and selling of stocks happen? Now that's a great question. Let's break it down. Imagine you're at an auction. You've got your eye on a beautiful, one-of-a-kind painting. As the auctioneer starts the bidding, the price of the painting begins to rise. The more people who want it, the higher the price goes. This, in a nutshell, is how the stock market works. When you buy stock, you're purchasing a piece of a company. Just like that painting, the more people who want a piece of that company, the higher the price of the stock will go. And just like at an auction, the person willing to pay the most gets the item. In the stock market, this process happens electronically, with millions of shares changing hands every single day. When you place an order to buy or sell a stock, it goes into a massive virtual auction. Here, potential buyers bid for stocks with their offer prices, and sellers ask for their desired prices. When the bid and ask prices match, a trade occurs. Now, where do these prices come from? Well, stock prices are largely influenced by supply and demand. If a company is doing well, more people will want to buy its stock. This increased demand, with an unchanged supply of stocks, tends to drive up the price. On the other hand, if a company isn't doing so well, people might want to sell their stocks. This increased supply, with unchanged demand, usually drives the price down. But remember, the stock market isn't just about numbers and prices. It's about people and their perceptions. If people think a company will do well, they're more likely to buy. If they think it will do poorly, they're more likely to sell. So, in essence, buying and selling stocks is a lot like an auction. The price isn't set by the company or the stock exchange, it's determined by us, the buyers and sellers in the market. Just like in an auction, the price of a stock is determined by how much people are willing to pay for it. Where do these transactions take place? Enter stock exchanges. Stock exchanges, you've likely heard of them, places like the New York Stock Exchange or the NASDAQ, but what exactly are they? Well, they are the beating heart of the stock market, the regulated arenas where the buying and selling of stocks occur. Stock exchanges are the central hubs of the global financial system. They are the platforms that facilitate the trade of stocks, bonds, and other securities. They serve as a meeting place for buyers and sellers, a virtual marketplace where shares of publicly traded companies are bought, sold, and issued. But why do we need stock exchanges? Can't we just buy and sell stocks directly? The answer lies in the concept of a fair and orderly market. Stock exchanges ensure that every transaction is transparent and conducted according to strict rules. They provide a level playing field for all investors, whether you're a Wall Street titan or a humble beginner dipping your toes into the stock market. Stock exchanges also play a crucial role in determining the price of stocks. Every stock listed on an exchange has a quoted price, which fluctuates based on supply and demand. If more people want to buy a stock than sell it, the price goes up. Conversely, if there are more sellers than buyers, the price goes down. This is the basic principle of supply and demand at work, orchestrated on a grand scale by stock exchanges. Moreover, stock exchanges are essential for companies too. They provide a platform for companies to raise capital by selling shares to the public. This capital can then be used to fund growth, research and development, or other business activities. In conclusion, stock exchanges are the lifeblood of the stock market. They are the places where the magic happens, where stocks are bought, sold, and priced, all under the watchful eyes of regulators. They are the engine rooms powering the world of finance. So, stock exchanges are like the physical locations of this global marketplace. Now, the million-dollar question: how do people make money in the stock market? Let's delve into the two main avenues. First up, dividends. This is when a company shares out a portion of its profits to its shareholders. Just like getting a slice of the pie, it's a way that companies say thank you for investing in them. Dividends can be a steady stream of income, particularly if you're invested in a company that regularly turns a profit. Now, onto the second method, selling stocks for a higher price than what you paid for them. This is where the saying buy low, sell high comes into play. For instance, let's say you bought shares in a company at $10 each. A few months down the line, the company's doing great, and the price per share has climbed to $15. If you decide to sell your shares at this point, you've made a profit of $5 per share. Sounds simple, right? But remember, the stock market isn't a guaranteed moneymaker. It's a bit like a roller coaster ride. Ups, downs, twists, and turns. There are periods of growth where the value of stocks generally goes up, known as bull markets. But then there are periods of decline, known as bear markets, where the value of stocks generally decreases. So, while investing in the stock market can be rewarding, it's not without its risks. The value of your investments can go down as well as up. That's why it's important to do your research, understand what you're investing in, and consider diversifying your portfolio. In other words, don't put all your eggs in one basket. And let's not forget, patience is a virtue in the stock market world. It's not about getting rich quick. It's about making informed decisions and playing the long game. So while the stock market can be a way to grow your wealth, it's important to remember that it comes with risks. Well, let's recap on what we've learned about the stock market. We started off by exploring the basics. The stock market is simply a place where buyers and sellers come together to trade shares in companies. We then delved into understanding stocks themselves, which are essentially pieces of ownership in a company. You learned about the process of buying and selling these stocks, and the pivotal role that stock exchanges play in facilitating these transactions. We also discussed how you can make money in the stock market primarily through capital gains and dividends. But remember, while the potential for profit is enticing, it's also important to be aware of the risks involved. So what's next? Continue learning, researching, and staying informed. The more you know, the better your chances of making sound investment decisions. Remember, the stock market is a powerful tool, but it's important to understand how it works before you dive in. Happy investing!